Happy Sunday, everyone. This is Mark Idem from HONU Trading with my weekly review. First, a disclaimer. For educational purposes only, never forget your first job is risk management. And if you want some updates during the week, follow me on Twitter at HONUMGMT. Just like last week, I want to be a bull, but the breadth has still got to pull its weight. Now, in these videos, I'm going to focus more on providing some perspective on the markets, intermarket perspectives, and hopefully an educational topic or two on different ways to use current or familiar market indicators. So welcome to earnings season. My sponsor last week was Led Zeppelin's Dazed and Confused. This week, the sponsor is Carl Jr.'s Hot Mess Burger, because in my humble opinion, the market is a hot mess. Before we get into that, I do want to talk about why I'm not going to spend much time on individual trading setups, and that's because there are different trading time frames. Long-term investors want to hold things for weeks to months. My preferred time frame is a swing trader. I want to hold things a few days to a few weeks. Day traders and scalpers, minutes to hours to maybe a day or two. So why do I call this a hot mess? And here's something I posted on Friday on Twitter. Let's call this 2 wins for the Bulls, 1 win for the Bears, and 2 draws. Now, in a bull market, we want to see things close lower, open lower, and close higher. We saw that both on Monday, and then on Thursday, PPI day, we saw it open higher and then close higher. Both pretty solid trend days. We had 2 draws, the pre-CPI chop and bank earnings on Friday. Gap lower, rally, fail hard, rally back to basically unchanged. We did have CPI day, and that was an ugly day. Gap up, fail, rally hard, fail harder. That's a clear win for the Bears. The second part of this is a quote from Maximus, and I almost made him our sponsor this week. Are you not entertained? Is this not why you're here? But I chose the Hot Mess Burger from Carl's Jr. because, like I said, I think the market's a hot mess right now. Next, let's look at the indexes, and you're going to see that the major indexes are basically at the same level as 1 or maybe even 2 years ago. No real change this week. And the reason I say breadth is poor and the breadth needs to pull its weight is that the cap-weighted indexes are driven by the big cap companies, and they're doing much, much better than the equal-weighted indexes. And the ratios are still very weak. What do I mean? Here's SPY on a weekly basis. Your key moving averages are slightly up, and we're not only above the AVWAP from the low in October, but the AVWAP from the high. The Qs are even better in that those indexes, or the moving averages, are up pretty sharply, especially the 10-week, and third week above the AVWAP from the all-time high, well above the AVWAP from the lows. But when you contrast that to the equal-weighted mid-caps, this is just flat. The key moving averages are flat. We're below the AVWAP from the high. We bounced off the AVWAP from the lows. Nothing to see here. Much, much weaker than the cap-weighted indexes. The small cappers are even worse. They're not only below the AVWAP from the high, they're below the AVWAP from the October low, and the key moving averages are trending lower. The ratios, equal weighted to cap weighted, falling off a cliff, still looks pretty ugly. Equal weighted Qs versus cap weighted Qs looks pretty ugly too. Financials aren't out of the woods yet, and like I've said before, 30 had better hold, and this week should be somewhat key for the financials because there's a lot of earnings coming up. Let's take a look. So this 30 level actually goes all the way back to the great financial crisis, 2007, 2008. And what was once resistance, once broken, should prove as support. And so far it has. Now this looks better this week. All of that happened on Friday because of the positive earnings from JP Morgan and Citigroup gapping higher and closing at the highs of the day. But this coming week, we've got a lot of financial sector earnings. Some of the big caps, Schwab on Monday, Bank America, on Tuesday, Morgan Stanley on Wednesday, Amex on Thursday. Amex is also one of the key stocks in the Dow, as is Travelers and Goldman Sachs. But look at all the smaller and mid-sized regional banks that report this week. So when we look at the big bank index, KBE, no real change despite the positive news from JP Morgan and Citi. The smaller regional banks, KRE, they look a little worse. No, they haven't fallen out of bed yet. This week should help tell the tale there. As far as the bond market, last week I said it was wild but a bit tamer. Now I'd call it tamer but still a bit wild, and here's why. We've been focusing on the wild moves in day to day in the 2-year Treasury. Well, that's calmed down a lot. This week was almost all, this was Friday. So looking at my converting the percent change in the 2-year Treasury to Dow Jones points using 35,000 as a baseline. I'm not sure this is mathematically correct, but it gives you a constant frame of reference, and it really helps put the volatility of the short-term bond market into perspective. When Silicon Valley Bank failed, we had 11 days in a row and 12 out of 13 with 1,000 Dow Jones points equivalent or higher. Last week, we had 2 of those days. This week, only 1. Another thing that's improved, this week, we had 2 days that were basically non-events. And since Silicon Valley Bank failed, there's only been 1 other day besides those 2 that was a non-event. And the biggest factor is the MOVE index, which is the VIX for the government bond market. That fell pretty sharply this week and back into more of a high but more normal range. So now let's get into the education segment, and I want to take a different look at the RSI. Now the RSI was developed by Wells Wilder back in 1978, but what I'm about to show you was developed by a gentleman I actually had a chance to meet at the MTA, Market Technicians Association, or now CMT Institute, named Andrew Cardwell. Well, sadly, Andrew passed away in June of last year, but his work lives on, and he looked at the RSI in terms of what happens during a bull phase and a bear phase. By definition, from Wells Wilder's perspective, overbought was around 70 on the RSI and 30 was oversold. Andrew Cardwell postulated that 70 or higher, even 80 or higher, could be your overbought level in a bull market, and 40 would be oversold in that same bull market. So 40, which is the support level in a bull market, that was tested a few times during this phase. Once we rallied above 60, which is the upper end, as you'll see in a minute, for a bear range, once we rallied above that in May of 2021, pretty solid bull phase. And notice how it got overbought and stayed overbought for the best part of 2 months. So markets can get overbought and just stay that way, or in a bear phase, oversold and stay that way. Now, in a bear range, once it drops below 40, then Andrew Cardwell found that 60 tends to be your overbought level in a bear phase. So once it drops below the support range and stays below 40 in a bull market, then the oversold drops to 20, overbought goes up to as much as 60. Then we had a period of time I'll call the WTF market, where it went into bull phase and bear phase almost within a month. And here's another log on the hot mess fire. Right now we have a bull phase indicated in RSI, but that's not been confirmed by new highs in the SPY. So in summary, we still have the hot mess market, and I don't see that changing until we get a catalyst. Now, earnings season could be that catalyst, and I hope it will be. So trade well, and I'm going to leave you with today's sponsor, the Carl's Jr. Hot Mess Burger. Take care, everybody. Talk to you next week.